There are 4 things seniors do with their bank accounts every week, things that feel completely normal, completely harmless, that are quietly generating red flags inside the IRS's automated system. 3 of them can trigger an audit notice. One of them, number 3, is not just a red flag. It is a federal crime. And the people committing it have no idea they're breaking the law, because they think they're being careful. In fiscal year 2024 alone, the IRS's automated matching system generated $7.7 billion in additional tax assessments, most of them from mismatches the taxpayer never even noticed. Stay with me through all 4. Because number 3 is the one that can put a senior in serious legal trouble for doing something that feels like common sense, and stopping it takes about 10 seconds. And here's why this matters more for seniors than for anyone else. Retirees deal almost entirely in fixed deposits, Social Security, pensions, IRA withdrawals, all of which the IRS already has records of. So when something unusual appears in your bank account, the mismatch is louder, faster, and easier for the system to catch. I'll show you exactly what the IRS sees when it looks at your account in just a moment. Move number 1. Depositing a large sum without a paper trail. This is the move that catches people during life's biggest transitions, and for seniors, those transitions happen more often than at any other age. You sell a car for $12,000 in cash. A family member sends you a $15,000 gift to help with home repairs. You receive an inheritance check for $40,000. You cash out a certificate of deposit at one bank and deposit the money at another. Each of these is perfectly legal. But to the IRS's system, each one looks like unexplained income. Here's how it works. Your bank reports the deposit to the IRS through a currency transaction report if it's over $10,000 in cash, and through normal account reporting for checks and electronic transfers. The IRS's automated underreporter program compares every deposit against every income document on file, your W-2s, your 1099s, your Social Security statements, your IRA distribution records. If a deposit shows up that doesn't match any of those, the system flags a discrepancy. For a senior whose income is entirely fixed, Social Security, a pension, maybe an IRA withdrawal, a sudden $40,000 deposit with no matching 1099 or documented source screams unreported income to the algorithm, even if it's a perfectly innocent inheritance. The fix is simple, but most people never do it. Keep documentation for every large deposit. If you sell something, keep the bill of sale. If you receive a gift, have the giver write a brief letter stating the amount and that it's a gift. If it's an inheritance, keep the estate paperwork. Store these records with your tax return for that year. If the IRS ever asks, you hand them the file and the conversation ends. Now move number 2, this one is quieter, but the IRS catches it almost every single time. Move number 2, not reporting the interest your bank already reported for you. This is the mismatch that the IRS's computer catches with near-perfect accuracy, and it's the one most seniors think is too small to matter. Every January, your bank sends you a Form 1099 INT showing the interest your accounts earned during the previous year. What most people don't realize is that the bank sends an identical copy directly to the IRS. The IRS now has the number. If your tax return doesn't include that exact same number, the computer flags it instantly. For many seniors, the amount is small, $30, $60, maybe a couple hundred if you have a high-yield savings account or a CD. They see the number, think it's insignificant, and leave it off their return. Or their tax software doesn't import it automatically, and they don't enter it manually. The IRS doesn't care if it's $30. Their system runs a line-by-line comparison, And any mismatch generates what's called a CP 2000 notice, a letter proposing additional tax based on income you didn't report. And the response rate on CP 2000 notices is roughly 95% in the IRS's favor, meaning almost everyone who gets one ends up owing. The fix takes about 2 minutes during tax season. Before you file, gather every 1,099 INT from every bank, brokerage, and credit union where you have money. Compare them against what's on your return. Every dollar of interest must match. If a 1,099 is missing, call the institution and request a copy or check your online account, where most banks post them by early February. Now here's move number 3, the one I told you at the start is not just a red flag but a federal crime. And it's the one most seniors need to stop doing immediately. Move number 3. Breaking up deposits or withdrawals to stay under $10,000. This is the move I warned you about, and it's the most dangerous on this entire list. Under federal law, every time you deposit or withdraw $10,000 or more in cash in a single day, your bank files a currency transaction report with the government. The report goes to the Financial Crimes Enforcement Network and into a federal database. Most people have heard of this rule, and many, including a huge number of seniors, have decided to be smart about it. Instead of depositing $12,000 at once, they deposit $6,000 on Monday and $6,000 on Friday. Instead of withdrawing $15,000, they pull out $7,000 from one branch and $8,000 from another. They think they're avoiding paperwork. They think they're staying under the radar. What they are actually doing is committing a federal crime called structuring, specifically violation of 31 U.S.C. Section 5324. Structuring is illegal regardless of whether the money itself is clean. You don't have to owe taxes. You don't have to be hiding anything. The act of deliberately breaking a transaction into smaller pieces to dodge the $10,000 reporting threshold is the crime itself. It carries potential penalties including fines, seizure of the money involved, and in serious cases, prison time. And banks are trained to spot it. In 2026, AI-powered transaction monitoring catches structuring patterns almost instantly. When the system detects it, the bank doesn't file the routine currency transaction report, it files a suspicious activity report, which goes directly to federal law enforcement and triggers far more serious review than a standard CTR ever would. Here's how to stop this immediately. If you need to deposit or withdraw a large amount of cash, $10,000, $15,000, $20,000, do it in one transaction. Walk into the bank. Make the deposit or withdrawal in full. Let them file the CTR. That report is routine. Millions are filed every year. Nothing happens to the vast majority of people whose names appear on them. What is not routine is the pattern of deliberately breaking up transactions. That pattern is what investigators look for, and that is what turns an innocent trip to the bank into a federal case. And now move number 4, this one doesn't involve cash at all, but it creates a mismatch that the IRS's system picks up like a siren. Move number 4. Transferring large amounts between accounts that the IRS can't explain. Here's the move that catches seniors who are simply trying to organize their money and accidentally create what looks like hidden income. You move $30,000 from your savings account at one bank to a new account at a different bank to get a better interest rate. You send $5,000 via Zelle to your adult child to help with a car payment. You receive $10,000 from a sibling who's splitting the proceeds from your parents' estate. Every one of these is normal. But to the IRS's system, each one can look like unexplained income if the numbers don't line up with what was reported on your return. Here's what happens behind the scenes. Both banks report account balances and activity. The IRS's system sees a large deposit appear in your new account that doesn't match any income document. It flags it. A CP 2000 notice follows, proposing additional tax on income you didn't earn. The fix mirrors move number 1. Document every significant transfer. If you're moving money between your own accounts, keep a record showing both accounts are yours and the transfer was not income. If you're sending money to family, keep a note of the amount, the date, and the purpose. If you're receiving money from family, ask them to write a brief letter confirming what it was: a gift, shared inheritance, reimbursement. The IRS is not trying to punish you for managing your money. They're trying to catch unreported income. When you can show, clearly and immediately, that a deposit is not income, the flag dies before it ever becomes an audit. Your 4-move protection plan. 1. Document every large deposit that isn't regular income: sales, gifts, inheritances, transfers. Keep proof with your tax return. 2. Report every dollar of bank interest on your return. Gather all 1099 INT forms before filing and match them line by line. 3. Never break up a cash transaction to stay under $10,000. If you need to make a large deposit or withdrawal, do it in one visit. Let the bank file the routine report. Structuring is a federal crime. Stop it today. 4. Keep records of all large transfers between accounts, Zelle payments to family, and money received from relatives. A simple note explaining the purpose prevents a mismatch from becoming an audit. Here's the bottom line. The IRS's automated system doesn't audit people, it audits numbers. When the numbers on your bank activity don't match the numbers on your tax return, the system fires. And for seniors whose income is almost entirely trackable, Social Security, pensions, IRA distributions, any unexplained deposit stands out like a red flare. The 4 moves I just showed you are the 4 that generate the most flags for retirees. Each one has a simple, immediate fix. And move number 3, the one where you break up transactions thinking you're being smart, is the one you need to stop before your next trip to the bank. Because what feels like common sense is a federal crime. So fix these this week. And if you know a senior who handles their own banking and does their own taxes, a parent, friend, a neighbor, send this to them today. Because the difference between a routine bank visit and a federal investigation is knowing where the lines are drawn.